Subscribe now and press the bell icon. Never miss an update.
Hi guys, this video is going to be on PUP on non-current assets. Now we've seen in another video that the parent and the subsidiary can sell goods to one another, making a profit, and this profit must be eliminated. Similarly, sometimes the parent and the subsidiary may sell non-current assets to one another, and this has to be eliminated by the means of a PUP adjustment as well. This PUP adjustment is going to be removed from the property, plant and equipment row on the face of the balance sheet. And how we calculate this PUP is very straightforward. You compare the net book value of the asset from the parent's point of view, pretending they've never sold it, and then you compare that to the net book value of the subsidiary's point of view. And the difference between these two net book values is the PUP. So let's have a go at this very nice example. Panther owns 80% of Tiger. An extract from the company's individual financial statements as at June 18 show the following. So PPE carrying amount. On the individual balance sheet for the parent, it's 370. And on the individual balance sheet for Tiger, the sub, is 285. That was at June 18. On the 1st of July 17, which was the first day of the year, Panther sold a piece of equipment which had a carrying amount of 70,000 to Tiger for 150,000. The equipment has an estimated remaining life of 5 years when sold. What is the carrying amount of property, plant and equipment in the consolidated statements of financial position of Panther at June 18? Now on the balance sheet, what you would do is take 100% of the parent's PPE and add it to 100% of the subsidiary's PPE. But then, since the parent sold a non-current asset to the subsidiary at a profit, there could be a PUP implication in this matter. So the PUP is calculated by taking the net book value from the parent's perspective and comparing it to the net book value from the subsidiary's perspective. Let's do it. From the parent's perspective, we pretend that the parent hasn't sold the asset. Now the asset had a carrying amount of 70,000 and it has a remaining life of 5 years. So because 1 year's gone by, after 1 year's worth of depreciation, the parent's net book value would be 56,000. 70,000 minus 70,000 divided by 5. Now, from the subsidiary's perspective, they bought the asset for 150 and the asset had a remaining life of 5 years. So applying 1 year's worth of depreciation, 150 take away 150 divided by 5, the net book value from the sub's perspective is 120,000. So therefore the difference between the two is 64,000. So when sold, the parent made a profit of 64, which must be eliminated. So on the face of the balance sheet, it's going to be 100% of the parent's PPE, 370, plus 100% of the subsidiary's PPE, 285, minus the 64,000 PUP. The sum of that gives you 591,000. And that's how you deal with PUP on non-current assets.